Hello everyone and welcome to this explainer. Today we're diving straight into a massive shift in the ESG landscape, the December 2025 WASP standards for the insurance industry. If you're involved in insurance, investment, or sustainability, you already know that reporting mandates are fundamentally evolving and fast. So let's cut through the noise. We're going to break down exactly what this means for carbon accounting and give you a really clear, structured understanding of these new regulatory requirements.
Okay, let's dive right into this roadmap. First, we'll look at the new reporting landscape, then decode financed emissions, report on scopes 1 through 3, calculate gross exposure, explain the methodology, and finally, prep for the future.
Starting with Part 1, the new reporting landscape and the 2025-12 amendments.
So to give some context, back in 2022, the International Sustainability Standards Board, the ISSB, officially took over responsibility for the SASB standards. And since then, they've been continually updating them to build this unified global baseline. Now, what's absolutely crucial for insurers to understand is that in December 2025, the ISSB amended the financed emissions metrics specifically within the insurance standard. The big goal here? To align these metrics directly with the overarching requirements in IFRS S2, specifically around greenhouse gas emissions disclosures. Basically, the frameworks are converging. It makes your reporting obligations way more standardized for sure, but also far more rigorous.
Moving on to Part 2, decoding financed emissions to understand the carbon code.
It's pretty much the biggest buzzword in the financial sector right now, but let's take a step back. What exactly are financed emissions according to the standard?
Well, the standard officially defines financed emissions as an indicator of your entity's exposure to climate-related risks, and opportunities, by the way, that arise directly from your counterparties, borrowers, or investees. So why does this matter so much? Think about it. If you're an insurer financing clients with really high emissions like fossil fuel projects or industries facing heavy carbon taxes, you're taking on very distinct risks. And these aren't just environmental risks anymore. They manifest as tangible credit risks, market risks from new technologies, and of course, major reputational risks. Insurers have to actively monitor and manage these exposures now, and measuring your financed emissions is literally the foundational way to do that.
Which brings us to Part 3, reporting scopes 1 to 3, focusing heavily on the carbon itself.
Now, what's really interesting about this rule is the sheer granularity it demands. You can't just lump all your emissions into one massive vague number anymore. No way. You are required to disaggregate your absolute gross financed emissions perfectly into Scope 1, Scope 2, and Scope 3 greenhouse gas emissions. And it goes even further. This data has to be broken down for each individual industry by asset class to make sure everything is globally comparable. The whole shebang has to be measured and reported in metric tons of CO2 equivalent. It is a highly specific, very matrixed approach to carbon reporting.
But there is a very important nuance here regarding what actually gets included in that calculation. The standard provides something called permitted relief. What this means is, for the purpose of this disclosure, you're actually allowed to exclude greenhouse gas emissions that are attributable to derivatives. However, if you choose to take that relief and leave those derivatives out, you can't just do it quietly. You have to explicitly explain to the users of your financial reports what exactly you treated as a derivative. You have to prove that your exclusions meet the technical definition of a derivative under IFRS accounting standards or your local GAAP. In short, transparency is everything. If you take the exemption, you absolutely have to show your receipts and explain why.
Let's look at Part 4, calculating your gross exposure, or the coverage. While we just talked about absolute carbon tonnage, this metric is all about establishing your financial denominator. You have to disclose your gross exposure for each industry, again, by asset class. And importantly, this has to be expressed in the exact presentation currency of your entity's financial statements. This is what gives your investors the true context of exactly how much capital is fundamentally tied to those emissions.
And that brings us to a magic number, 100%. Metric FN in 410C.3 specifically asks for the percentage of your gross exposure that is actually included in your financed emissions calculation. Now, if your coverage is anything less than 100%, you cannot hide behind incomplete data. The mandate is incredibly strict here. You must explain the exact assets you left out. Any gaps in your coverage have to be completely justified and transparently disclosed. No exceptions.
Moving into Part 5, explaining your methodology, otherwise known as the math.
So just reporting the numbers isn't going to cut it anymore. It's like being back in math class. You have to show your work. The standard requires a full narrative discussion of your methodology.
Step 1 is stating your estimation method, applying the core principles found in IFRS S1. Then Step 2 is allocation. You have to detail exactly how you calculated your firm's specific slice of the emissions pie, based on the size of your financial exposure. It's all about demystifying the calculation process. When you show your work clearly, stakeholders and regulators can actually trust the math behind your metrics.
And this brilliantly illustrates all those highly technical pieces we've just discussed anchored into one clean, readable summary. You've got your absolute emissions in metric tons, your gross exposure in your presentation currency, the percentage of that exposure actually calculated, and your qualitative methodology discussion. Together, these 4 pillars give a comprehensive, fully transparent view of an insurer's climate-related financial risk profile.
Finally, Part 6, Preparing for the Future and the 2027 Horizon.
So let's talk timelines. We saw the non-climate international applicability amendments roll out back in December 2023. Then came the critical December 2025 amendments from the ISSB, which align these financed emissions metrics with IFRS S2, which is what we've been unpacking today. But the hard regulatory horizon you really need to be aiming for is January 1, 2027. That is when this 2025-12 standard officially goes into effect for annual reporting periods. Now, early application is permitted, and honestly, it's encouraged if you want to be competitive with your transparency. But make no mistake, 2027 is the absolute finish line for your preparation.
We've seen just how rigorous the disaggregation of Scopes 1, 2, and 3 has to be. We've gone over the strict rules around derivatives and the hard mandate to explain any exposure that's less than 100%. The technical requirements are crystal clear, and that 2027 deadline is approaching fast. So, I'll leave you with this final, provocative thought to consider for your own firm. Are your portfolios truly ready for absolute transparency? Thank you so much for joining me for this explainer. Keep learning, keep structuring that data, and I will see you next time.